So guys, this is probably one of the most anticipated videos that I've been getting, as requests from my students especially, but we're going to be looking at the asset class correlations. So if you remember back to one of our first videos that we did in the first section of fundamentals, we looked at the various different types of asset classes. So that was mainly the equities markets, which is stocks. Then of course we had the bond market, the currency market, and then commodity market. In this first lesson, we're going to be looking at stocks and bonds. So let's start off with the treasury bond market. So as you understand from treasury bond market, that means the US 10 yield, of course. We've learned about the bonds and the yields. You understand that there's, of course, 2-year bonds, for example, 3-month bonds, 30-year bonds. It ranges. There's different maturity dates. Now, the correlation that you've got to understand is usually, especially when there's big news events that leads to these different types of price moves, you start to see that as DXY strengthens, US 10 yield also strengthens. And also instead, US 10 simply just declines. The reason for this is quite logical. As bond prices go up, interest rates go down, the yield goes down too. As bond prices go down, interest rates go up, the yield goes up too. Now think of this. The higher interest rate environment means a higher return on the bond, so higher returns on the investment as well. Therefore, there's more investment into the country. Now, this is something that you guys should understand until now, because you've got to think about it like this. You always must understand where is investment going into, and then what effect does that have firstly on the bond market, and then how that translates into the US dollar. So the second type that we're looking at is the stock market. Now, over the last 20 years, there's been a 40% positive correlation between the S&P 500 and DXY. Because of foreign investment, they invest into the US stock, so they need to exchange money into USD. Therefore, as more investment happens into the S&P 500, USD should also rise at the same time as well. Times when there's immense global uncertainty, international trade slows down. Therefore, USD increases because safe haven and demand appeal. Slowdown in trade slows down USD liquidity. USD is a safe haven in these times, so risk assets like stocks decline as investors would much rather go for safer investments, such as into indexes, and of course, from what we've seen, the bond market. Now, just actually looking at the asset class correlation between the stocks and the dollar. So what we've got here is the dollar is in blue, I believe it is, and then the stock market is in orange. Let me just check that real quick. No, the orange is DXY and blue is the stock market. So as we can see, the stock market is always, we always see a rise in the stock market. We've got 2008 crisis. So what happened then? The dollar increased because it was treated like a safe haven, and stocks went down at that time. In 2015, the Fed tapered back the quantitative easing program. So if we think back to that lesson where we learned about quantitative easing, and then the lesson afterwards where we talked about how tapering occurs, this is exactly what happened. In 2015, the Fed actually tapered back quantitative easing. Therefore, the US dollar boosted all the way up, as seen by this orange line over here. Stocks made a slightly positive gain, but USD had big divergences from global currencies. So what this means is, whilst USD was increasing in price, lots of other currencies were not doing the same. Now, that's mainly because the Fed had one of the first, we won't call it completely successful tapering plan, because if you actually look into the history of tapering and slowing down the bond purchases, there's never actually really been a successful one. It's always gone on the quantitative easing program. But USD had a much more successful one. Therefore, it had a massive divergence from other global currencies. You can also see on charts at that time, Euro USD saw so much downside because of mainly the strength into USD and also um, logically thinking the investment at the time. Lots of people were investing into the US economy, therefore not as much investment was going into the Eurozone. In 2017, we saw global synchronized growth like China and the Eurozone. So whereas at the time in 2015, where we saw DXY massively increase because of the US monetary policy, 2 years later on, that's when we started to see a lot of the other global economies following suit after this, after what they happened and what they led. China started to get stronger as well, especially the Eurozone. Another thing as well, the dollar doesn't like reflation. So what you tend to see is as the dollar really, started to deflate at that time, it's called reflation. It goes back to how it was. That's when the dollar started to decrease in price as well. As we started decreasing, S&P 500 saw good gains. Now, this is the point that I made in the beginning. Over the last 20 years, there's been a 40% positive correlation. Now, as you can see, over time, as the S&P 500 increases and grows, so does DXY. However, this isn't always the case. You've got to understand that long term, there's this correlation because you've got to think about investments into that country and how it affects stock prices and everything like that. But in terms of the lower time frames, you're not really going to see this as a direct correlation as compared to what we may see in the US 10 yield market and DXY, for example. So what you must understand about S&P 500 and DXY, there is no general rule to the correlation, particularly in the short term. So you must understand the global economics at the time and look for the movement of money into certain asset classes. Which one makes sense to perform better? Where are people seeking their safe havens? Where are they seeking that better yield? Are they seeking an investment for a hedge against inflation, for example? Now, during times of crisis, riskier investments are not preferred, hence why stocks may suffer a bit during these times. But ultimately, the S&P 500 makes positive gains over the many years. Here, for example, during COVID lockdowns, back in June of 2020, this was, I believe, on a 4-hour chart between S&P 500 index and the DXY. During COVID lockdowns, there was a complete inverse correlation between S&P 500 and DXY. So the takeaway lesson from all of this, there's actually no set rule of what you may see in the short term. So whereas if we look at, Euro USD and DXY, for example, I see a direct correlation, particularly on the lower time frame. But when it comes to the stock market and the US dollar, we don't see that direct correlation. But of course, consider this long term, understand where money actually flows, where capital and investment is going into, and that will give us a clearer and better understanding of the market, particularly long term. Anyways, guys, that's it for the first lesson of the asset class correlations. I hope this all makes sense, and I'll see you in the next video.